How do you leverage your money in retirement so you can spend what you want and still leave money to your family? In today's video, we are going to go over exactly how you can do that. So what we have is a case we are currently working on. We've got a client who is 58 years old. They have an old retirement account with about $228,000 in there. They do not want to take on any risk, and they want to use this for income. However, they're nervous about spending this because it's the classic situation. If I dip into my principal, it's going to shrink the balance, and then I can't leave as much money to my family as I'd like to. So they want to leave about $200,000 to their family. So an option was shown, which was a growth annuity. So what this was specifically is what is called an indexed annuity. Here we go. So they had about $228,000 that they were looking to move into an indexed annuity. Here we've got the account value, and then over here we have the surrender value. So with an indexed annuity, typically you will see what is called a surrender period. The average is 7 to 10 years, which means if you cash the annuity out or if you transfer it to a different annuity, you have to eat the surrender hit, which is not fun at all. So the account value displays what the account is growing by over time, and the surrender value represents what you get after the surrender charges if you were to cash it out. Now what you'll notice is after the 10th year, the values are the same, the account value and the surrender value, because the surrender period is expired. It had a set 10-year surrender period. Now the account crediting rate is based on the market history. This is all hypothetical. But with that said, she liked this type of annuity because she had upside potential. If the market goes up, she goes up with it. If the market goes down, she does not lose any money. That's how an indexed annuity works. So if we look at this guy, what we have is this. This makes it a bit cleaner so we can also see the surrender charge. So transfer from the old retirement account, account value, surrender charge, not value. So these represent the actual fees that she would be dinged with if she cashed out the annuity. And then you have the surrender value, which is the net dollar amount you'll get after the surrender charges, which this came from an old retirement account, which means it was all pre-tax dollars. So this is the net amount you would get from the insurance company, and then you would have to deal with taxes on it. We always want to remember that. But this is the growth annuity, and let's assume she doesn't touch it for 10 years or she just takes some of the money out. With these types of annuities, you can always access 10% of the account value without any surrender penalties. But as we look at this over time, could she work it out where she takes just enough money where she always leaves a $200,000 balance to be left to her beneficiaries? She could, but it would be challenging. She'd always be looking at it, and it would stress her out. So a hands-off approach she can take is, instead of just looking at a growth annuity, we ask this question: how do I spend my money and also pass on my money? So what we look to do here is leverage what's called an income annuity plus a whole life insurance policy that can provide a guaranteed death benefit that's also paid income tax-free. So when we look at this guy, here's the plan. Step 1, transfer funds to an income annuity. The income annuity is going to guarantee a little bit more than $15,000 per year if she starts income about 12 months from today. Now that $15,000, we're then going to move that into a whole life insurance policy, but we're not going to fund it forever because eventually she wants to live on this $15,000. She's got a lot more income than that. It's not just $15K. She wants to have this $15K supplement her lifestyle income. But what we're going to do is fund the policy for 7 years, and then after that, we'll stop funding it and see what it looks like. You'll see that it will start out with a death benefit of $250,000, which with a life insurance policy, the death benefit is always paid out 100% income tax-free. If you go back to her original plan or her goals, She wanted to leave $200,000 to her family. Does this accomplish that? Well, on paper, yes. We've got to look at the actual numbers though. So she can now leave that death benefit of $250,000 to her family. Here's the cool part though, which is number 5. The cash value is going to be worth more than what she paid into the policy. And then after age 65, she'll stop funding the policy and then has another $15,000 per year that is guaranteed to continue to be paid to her for the rest of her life. Let's take a look at the numbers. So we've got an income annuity and a life insurance illustration. If we take a look at the life insurance illustration, it's going to be based on this, $15,000 per year for 7 years. You'll notice that the life insurance policy starts at 59 because she's deferring income for 12 months with the annuity. So let's take a look. We'll start with our income annuity. So what we've got here is the $228,000 transfer from the old retirement account. We're not taking immediate income. It's deferred for 1 year in this plan. So what that means is after 12 months, she is guaranteed from this annuity company about $1,300 per month, which comes out to $15,593 per year. So this is the yearly income that she's going to receive from the annuity company. So it's guaranteed to be paid forever. So no management, nothing like that. She gets that check every single year. And if it's paid monthly, she gets it every single month. So the plan is for the first 7 years, I should say, age 59 through age 65, we're going to take that income and use it to fund her whole life insurance policy. So when we look at the life insurance policy, here we go. We're taking that $15,000 and change, moving it into the policy. We round it down just to $15,000 per year for the life insurance policy. But this is the money going in. Here's your cash value. So immediately, $15,000 goes in. She's got $13,000 in cash value. We're beefing up that cash value, so in the event that she needs or wants it, she still has access to it. We do not want a policy where we have 0 or a small percentage of our cash value in the policy. It's a common sales strategy in the insurance industry where we're using a life insurance policy, where we're using an annuity to fund a life insurance policy. A common pitch is, well, you won't need access to the cash value in the life insurance policy, so we can use this $15,000 and put it all toward premium in the life insurance policy. That makes the policy look horrible in terms of cash value. It does not look as good long-term when we look at the death benefit, and generates a fat commission for the agent selling the policy. So I would always recommend look at the high cash value up front because that also results in the most death benefit long-term as well. So you've got the $15,000 per year going in. There's the cash value in the first year. Break-even point, year 4, I've paid in 60, I have 60, and look at your death benefit. You're at $250 right out of the gates. Now, at 65, we're going to stop funding the policy. She's paid a total of $105, and she has almost $114 to show for it, along with that $250,000 death benefit. Now, after the funding period, we see 0 going in, death benefit stays at $250, but eventually begins to climb up. And this is a whole life insurance policy. So what happens after the first 7 years, that annuity is still producing $15,000 and change per year in income. So that's still coming out, but the difference is we're no longer using it to fund the policy because our payments are 0. Instead, we're using it for fun. All right, fun. Yay. So we've got the $15,000 and change per year coming out, and this is used for lifestyle, for whatever she'd like. If she says some years, I don't need all of it, I have some extra funds, can I keep putting it into the policy to beef up the cash value and beef up that death benefit? The answer is yes. If she wants to keep adding to the policy, she could easily do that, which results in even a larger legacy passed to her beneficiaries. The last thing I want to hit on here is just what she got out of that $228,000. So she had $230,000, call it, to work with. What that immediately produced is $15,500, call it, per year in income. By the time she is 90 years old, how much income did she receive? Well, if we scroll down here, because we got to go down a bit, there we go. At 90, the income was guaranteed. She's received $498 and change. Can we call it $500,000? So total income, $500,000. She put in $230, she got $500 back. How much does she leave? $354, income tax-free. So at 90, the death benefit, let's call it DB, that's from the life insurance policy, is $350. But here's the huge advantage to this. That is paid income tax-free. And that could actually be significantly higher if we looked at a different product that's more geared for long-term performance regarding the cash value and death benefit, or if she continued to add money to the policy. For example, if she keeps paying the $1,500 minimum premium, that'll really beef up the long-term value as well. But she used $230 to generate $500,000 in income and also leave another $350, so that $230 produced, call it, $830 of total value for her today and tomorrow when she eventually leaves money to her beneficiaries. So I do hope you enjoyed this case study. This was a quick one. If you have any questions, comments, or thoughts, please leave them in the comments below. And as always, I hope this helps. Thanks so much.